Hi, everybody. Before we get started, please take a minute to click subscribe to my channel to keep up with all of my latest investing and personal finance content. And please check the link you see on your screen for a message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So, if I were only allowed to buy ETFs, I would probably keep my portfolio pretty simple. I wouldn't, chase actively managed ETFs that try to beat the market, things like that. The reality is that with just a portfolio of basic index funds, like the one you see on your screen, the Vanguard S&P 500 ETF, it's possible to generate some pretty impressive returns over time. So we'll start with that one. If I were to just construct a portfolio out of ETFs, about half of it would probably just go into this one index fund. There's a solid argument to be made about an S&P 500 index fund as just a standalone investment portfolio for most people. So the quick description is that this tracks the performance of the S&P 500 benchmark index over time, and that's kind of a fancy way for saying this invests your money in all 500 companies that make up the S&P 500. It is a very popular index fund with about $745 billion in total assets, and for good reason. That expense ratio is the fees you pay on this investment, and 0.03% is very, very cheap. This means that if you invest $10,000 in this fund, your annual investment expenses will be just $3. So it leaves more of your returns for you to grow and compound over time and not to pay managers. You can see the top holdings shouldn't come as a surprise. This is the benchmark stock index. So the companies are just the largest companies in the market. Apple, Microsoft, Amazon, and Berkshire Hathaway are the top four right now. Next, I would take some of my money and put it in a small cap ETF. Small caps are, they have more growth potential, but more volatility over the short run in general. The Vanguard Small Cap ETF, if you notice, I pick a lot of Vanguard ETFs because of those low expense ratios, like I mentioned. The short answer is this invests in about 1,500 stocks with median market cap of $5.3 billion. So not tiny companies. These are pretty decent sized companies, but not nearly the size and maturity level that you see in the S&P 500. About $112 billion in total assets. So pretty popular index fund. Expense ratio is not quite as low as the S&P 500 version, but that is still very, very low in the fund world. And there's the top five holdings right there. First Solar, Steel Dynamics, Atmos Energy, Targa Resources, and IDEX. If you haven't heard of some of those or even all of them, that's kind of the point with the small cap investing. These are more up and coming companies that are still early on in reaching their market potential. And as a result, as a whole, they can deliver market beating performance over the long term. But in the short term, they tend to react more to market movements and things like that. So next, and I would probably at this stage, I'm 40 years old, I would probably just put about 10% of my money into a bond market ETF like this one. The Vanguard Total Bond Market ETF, ticker symbol is BND for that one. It, as the name implies, it invests in pretty much any type of bond or fixed income investment you could think of. It has government bonds, that's about 2/3 of the portfolio. It invests in some corporate bonds. You'll see a lot of names you recognize in their portfolio. And I can't name them all because in all there are 9,600 or so different investments in this fund. It's meant to just be a total representation of the bond market without putting too much of your money in any one single type of security. Even within that broad 2/3 of the portfolio in government securities, there are hundreds of different government securities that make up that portion. So a very, very diversified bond fund. You've probably heard you need to invest, 10%, 20%, whatever of your money in fixed income or bonds. This is a great way to do it without any guesswork or buying individual bonds or things like that. Second, and I don't really think of this as a bond investment. I would probably put about 10% of my money in a TIPS bond fund. TIPS stands for Treasury Inflation Protected Securities. These are special Treasury bonds that are designed to pay more in inflationary periods like we're in right now. Pretty popular fund, not as big as the Vanguard ones I mentioned. About $23 billion in investor assets are in this one. A little higher expense ratio, which is common with kind of a specialized fund like this. It holds one kind of security, Treasury Inflation Protected Securities. So at times like right now, you'll see these funds pay a whole lot more. The idea is that this is kind of a hedge against the damaging effects of inflation. The Vanguard Total Bond Fund that I mentioned on the previous slide will pay more. The yields will generally gravitate higher in inflationary and high interest periods, but not proportionally. This fund is designed to really offset the impact of inflation. Now, the downside is if inflation is under control or even goes to zero, this fund can pay almost nothing. So in inflationary periods, this just kind of protects your money, your purchasing power, from the effects of inflation. Next is the Vanguard Real Estate ETF, ticker symbol VNQ. This invests in an index of REITs, or real estate investment trusts. This is a big fund, about $63 billion, which is pretty big for a sector-specific ETF like this. And that expense ratio is of 0.12 is pretty low for a sector-specific ETF. These are companies that own and operate commercial real estate. Just looking at those top holdings, Prologis is an industrial REIT. It owns a lot of distribution centers. Like if you know those giant Amazon buildings, a lot of those are owned by Prologis. American Tower is one of the largest REITs in the world. It owns over 100,000 cell towers. If you see those big cell towers located on the highway, it owns that type of real estate. Equinix is a data center real estate company. You'll also find apartment real estate in this, office real estate, hotel real estate, you name it, it's in this index fund. And REITs and the overall stock market tend to produce about the same type of returns over the long term, but aren't terribly correlated in terms of volatility and performance in any given short period of time. So it's a nice kind of offset way to diversify. So I would definitely put some of my money into that. So just to recap, I'd probably put about half of my money in the S&P 500. I'd probably put about 20% in the small cap fund and 10% in the total bond market, the TIPS fund, and this real estate ETF. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.